Hi there, and welcome to the Stockscores Market Minutes for July 12th, 2013. This week's topic, it's a numbers game. What do I mean by that? Well, let's get right into it. Strategy trading, which is what I do, successfully requires a strategy with a positive expected value. What that means is that if you apply those rules over a large number of trades, let's say 30, 40 or more trades, it will make money. Now, you don't know if it will make money on the next trade. You just know that if you do it over and over again, it consistently makes a profit. Well, strategy testing assumes you take every trade. When you go through that process of back testing and developing a strategy, you assume that you take every trade in your sample. And the reality is that in the real market, it's easy to miss some, and that can affect your performance. It's important, therefore, to not judge a strategy by small sample sizes. If you do 4 trades in one day and they are all losers, even though you're applying a strategy that, when tested, consistently made you money, that doesn't mean there's something wrong with the strategy. You could have just had bad luck and picked the 4 out of 20 that actually lost money. So what's important is to judge your strategy over a large number of trades when you are actually doing it. Now, for example, today there were 11 stocks that met the criteria of my day trading strategy. Now, of those 11, 3 of them made large profits. One of them made a risk reward of 5 or 6, another one was 3, one was 4. But 5 of the 11 only made small profits or break even, and 3 out of the 11 made their small losses of a 1 element of reward for risk. Now, if just by bad luck you only did 3 trades today and you took the 3 that were losers, you'd say, wow, what a terrible strategy. If you took every trade, well, the total reward for risk for the day was about 10. And if you failed to take 2 or 3 of the big profits, then you barely broke even. What I'm trying to say is that the profits for the day came from a relatively small number of trades, and it's not out of the realm of possibility that you could have missed those big winners. And if you did, it meant that the day was not a winning day. That does not mean, however, that the strategy was not a winning strategy. All right, let's get into the analysis for this week. The S&P has been on a bit of a stealth rally, typically a gap up in the morning, and then it goes narrow range sideways all day long. And that's why we've got those narrow candles over the last couple of weeks. But right now, the market has rallied into resistance on fairly light volume. That tells me that we'll probably stall here, but we still haven't seen any sign of a stall. So I like the market longer term. I just think there's a good chance the market gets stuck here and pulls back. The Toronto Stock Exchange has rallied higher, led largely by some recovery in the energy sector on the back of stronger oil prices, but it remains in that sideways trading range that it has been in for a long time. And that is a difficult market condition to trade and something that is not too exciting. We do get the odd trading opportunity in Canada right now, but they're relatively few and far between. And I think it's important to be pretty conservative in the Canadian market right now. The US bond market remains in a downward trend as talk of the end of the quantitative easing is in the market. Of course, people are taking money out of the bond market because that's where a lot of buying has been going on by the US Federal Reserve. As that ends, people want to unwind those positions that they are long of, and so it remains a downward trend that is now 2.5 months old. The Emerging Markets Index Fund, which is a basket of emerging markets, has broken its downward trend and done so from a rising bottom. Now, the strength is encouraging, and the fact that it came from a rising bottom is encouraging, but we should note that there's been quite a bit of volatility lately, and so that means there's a lot of uncertainty. In other words, the market wants to buy this sector of the world economy, and it thinks things are getting better, but there's still a lot of uncertainty there. And so I think you have to be pretty conservative in how you trade it. Maybe buy weakness, pullbacks, that sort of thing, but I think it's still too early to say that the emerging market is rebounding and turning around. It is certainly stabilizing, and that's a positive, but still has work to do. This is a very interesting chart of the US dollar, and I've drawn it in this pattern to show how volatility has increased dramatically over the last 3 months. In other words, there's a lot more uncertainty around the US dollar. So the more volatility you have, the more uncertainty. We see lots of big price swings in the US dollar, and that makes it difficult to predict. It also is a sign that the market really doesn't know what's going on with Fed easing. Are they going to end? Are they going to add more? Are they going to just continue what they've been doing? There's lots of uncertainty there, and so that's why we get so much volatility in the US dollar. Gold remains in a downward trend. It got oversold at the end of June. It's bouncing back, but it has not yet broken that downward trend line. And so we should remain bearish of gold until we can see some sign of optimism. Right now, that little bit of strength that we've had over the last couple of weeks is really just a bounce back from oversold conditions. Oil has had a pretty nice run over the last couple of weeks. It's something I consider to be a dangerous run because I don't think the strength in oil is the result of global economic strength, which would be strong demand and that sort of thing. Instead, it's a lot of concern about what's happening in Egypt. Of course, Egypt has the Suez Canal, which is an important gateway for oil out of the Middle East. And if that shuts down, well, then there's a supply problem for oil. There really isn't a big supply problem. It's really just a political problem that we have in the oil market. And that's why I think this is fragile. We've seen this before. When there was problems in Libya, we had a spike in oil. When the problems went away, oil dropped pretty hard. So we can't discount the fact that there is a bull market in oil, at least over the last couple of weeks, but I suggest some caution in trading the oil market simply because I do think it is based on politics, which is a fragile situation. And of course, fear has moved to new lows. The VIX is at new lows, and therefore fear is not a factor in this market. I am neutral on US stocks. I think it's good longer term. I just think we're going to get stuck here in the short term. Canadian stocks neutral. We're in that long-term sideways trading range, which we bounce around in. Bearish on gold, bullish on oil, but as I said, the oil market is a bit of a fragile bull market. Well, that has been the Stockscores Market Minutes for July 12th, 2013. Have a great week in the market and trade well.